Happy New Year, everyone. And this is the first Business Over Breakfast of 2025. Oh, Tina, I would love to be in Tampa at 54. And I'm Nicola Barrett, Chief Corporate Learning Officer at Emory Executive Education at the University, the Goizueta Business School. So welcome to Business Over Breakfast. And we're glad to have you join us this morning as we explore a new and critically important topic for business, and in fact for anyone with savings and retirement funds. It's about power plays in the boardroom, the mechanics of shareholder democracy. Shareholder activism has surged in influence, transforming from a niche practice into a powerful force in corporate governance. And the shift is driven by the rise of institutional investors, increased focus on environmental, social, and governance issues, and enhanced shareholder organization through digital platforms. Today, we're going to explore how shareholder voting and activism influences leadership, strategy, and value creation, drawing on real-world examples from Disney, Apple, Yahoo, DuPont. Professor Wei Jiang will uncover the strategies behind proxy battles, contested board elections, and control challenges. It all sounds very exciting. Wei Jiang is the Vice Dean for Faculty and Research at Goizueta Business School and the Asa Griggs Candler Professor of Finance at the Business School, at Emory's Goizueta Business School. She is a scholar of note, having got her PhD in economics from the University of Chicago. She is a fellow and board member of the European Corporate Governance Institute and a research associate of the National Bureau of Economic Research. Her main research interests lie in corporate governance, institutional investors, technology, and financial markets. She's published extensively in top finance, economics, and law journals and received numerous awards for her research excellence. There's a fun fact about Wei, which sort of made me sort of feel a little inadequate. Wei, she didn't attend high school. She went directly from finishing middle school to college, something that her parents were immensely proud of. And she can tell the rest of the story about that if she would like. Today, Wei's going to spend the first 30 to 35 minutes sharing her insights, followed by Q&A. And as with all our webinars, please post your questions either in the Q&A box. Wei's happy to answer some of those along the way for clarification help. And also we've reserved time at the end for more in-depth questions. And we'll do our best to get to as many of those as possible. But before I hand over to Wei, just a few reminders about some upcoming program offerings that we have. So if you or someone you know or work with are really seeking to accelerate their career and their capabilities, I invite you to check out some of the short courses that that are coming up in the spring. Managerial leadership programs. So for those folks that really want to hone their leadership, understanding of how they lead as a person and how they lead their teams, please think about a managerial leadership program. The executive communication and leadership presence, again, in terms of communicating and how do you show up. That is a tremendously exciting and interesting program for people hoping to hone their communication skills. I feel like today I should take that one. And also leveraging AI for business. So how do you think about AI in your role, in your business? How do you think about that as a strategic force shaping both your workforce and your business? So please check those out, and we'll put a link to those in the chat. So thank you for joining us this morning, and I am going to hand over to Wei.
Good morning, everybody. I feel so honored that you are having breakfast with me. Thanks for Nicola for the introduction. Now, she mentioned that I didn't go to high school, but when I came to the US, my friends, classmates asked me about my high school experience, and I said I didn't have any. And all of them were stunned. And one of them even asked me, say, hey, what kind of parents did you have that were taking those important years out of your life? So this is not something I will recommend for your kids. So let's get back to today's topic. So I would say during the last 8 years, it has been in the news, in the headline about elections and democracy. So let's talk about another parallel line of democracy, which is what I call shareholder democracy. Now, this is what you probably had in middle school for Western civilization. So what is democracy? So in the political democracy, we have two types. On the left of the panel, that is Athenian democracy prevailing about 500 BC. So this place on a hill is called a Nix. So the citizen, not all citizens, actually male citizen over 18 years old, they were congregating in this hilltop, discussing, debating public policies from the whether you launch a war, how do you levy tax, how to distribute properties, etc. And in the end, they raise their hands and vote. So this is direct democracy. Now, about 500 years later, we had another form of democracy, which is Roman Republic. So this chart, this figure shows the early form of a Senate. Okay? So the citizens will vote for their representatives, who will in turn debate and discuss and vote on the most important policies of the society or of the nation. So the first one, we called it direct democracy, and the second, we called it representative democracies. Now, both forms have very ready mapping into the shareholder democracy or shareholder governance system. So for direct democracy, I believe everybody in the audience is a shareholder one way or the other. You might hold share directly, you might hold shares through ETFs, mutual funds, retirement accounts, etc. Most of the time, we are exercising our democracies through the Roman Republic format. Okay, so you vote for the board usually consists of 10 directors. They are legitimately voted in by the shareholders, and they are determining the day-to-day oversight and strategy setting on our behalf. But every once in a while, we also get to vote directly in the form of Athenian democracy. So for example, if a company is about to be taken over, you get to cast your vote. And also the time when Elon Musk had a $56 billion pay package, and the board also decided to put on a shareholder advisory vote. So we have both. Okay, so let me dig a little bit deeper to see what are the similarities or some differences between a political election versus a shareholder election. Now, in the political election, one person, one vote, and the analogy will be one share, one vote. Now, unless you have dual class. Okay, so about 5% of the public listed companies are dual class. In the typical case, say Meta, a company, the former Facebook company everybody knows. Now, Zuckerberg and his trust funds and his insider group, they own a special superior share, and their one share is 10 votes. Okay, and our common share is one share, one vote. So on the dual class system, suppose Zuckerberg owns 20 and his group, okay, owns 25%. They are controlling about 74.3, so almost 3/4 of the votes. Okay, but 95% of companies are one share, one vote. So you can view dual class share as exception. Now, are shareholder votes always look like political votes? I would say no, not in democracy. So I will tell you about 98% of the board elections, or what I call the non-contested elections, meaning the nominating committee of the incumbent board put forward a slate, and you as a shareholder has the choice to vote for or withhold. Because it's non-contested, you're not able to nominate your alternative candidate or slate. Okay, so I would think this election is very, very similar to election in an autocracy or some dictatorship. Okay, so you have one person who's up for voting and everybody just vote for. Okay, and occasionally someone withhold votes. So the typical non-contested votes will get, the candidates will get support from the low to middle 90s, like 93%, 95%, those are the typical votes. So they're not really the political elections in a democracy that you will think. So it's really not the case. Okay. So when the two do become similar, the 2% of the elections that become contested. Okay. So you will hear about the words like contested election or just about proxy contest. If you see about proxy contest, it's really about a contested election to the board. Okay. So the proxy context gets very close to our democratic political elections. So you have an incumbent, which is the current board nominees, and versus a challenger, those are dissident nominees. Okay, the elections are governed by law, the securities law, and both sides run campaigns and outreach. Okay, and they hire layers of advisors and they try to gain media influence. Okay, so an interesting fact that if someone runs a the US presidential campaign, and that human capital or that talent will become very attractive to a hedge fund. Okay, so I met the public campaign team of a very I would say very loud activist, the Allied Associate. So 2 or 3 members of the team were the team of Rubio's 2016 primary election campaign team. So you can see these connections really quite direct, meaning they require the same type of skills. Now, the election outcome is completely and solely determined by the voting tally. The one that win the higher votes gets win. Okay. And in the proxy context, that the same, whether it's complaint or grief about the grassroots retail shareholders versus elites, the BlackRock, the Vanguard's world, those are the large asset managers or owners. Okay, so now I hope you can see all these analogies. Okay, so I've done research in this area for over a decade, such as pick out some numbers from my research. So the fact that the numbers are not easy to get is that you really need to go to the individual proxy statements and some MPX forms. And in the old days, I had research assistants, manually track the numbers. Now we run machine learning scripts, make it easier. So we can literally get it into the individual investor, how they vote on the individual case. Okay, so very quickly you get millions of records. Now, in a typical year, 1 or 2% of firms are targeted in a contested election. Okay, so meaning 98% of the time you go ahead with your own slate and rubber stamps through the election. Now, once you get into proxy fight, 44% of the ones that actually go to the voting stage. So this is like a lawsuit. It's not like the lawsuit starts and you go to the court. Okay, the majority are settled outside the context. Something I later talk about. Okay, now here is a very interesting statistics, meaning conditional on a proxy context actually goes to a voting stage. The dissident won 49.1% time. Now, what is this 49.1% time? I take it as meaning half. Okay, so it is like 2 sides decide to go into a duel. Okay, so if you know you're for sure to lose, you will retreat. Okay, and if you know if the other side think they're going to lose, they're going to settle. So when neither side, so the dissident can retreat. Okay, can just withdraw, and the incumbent can offer to settle. Okay, if the incumbent does not want to settle, the dissident does not want to withdraw, meaning each side perceives that they have about half the chance. Okay, and that's backed out by the reality. So whenever I see this number, I always just marvel at this wonder of a market economy. Just get it so right. Okay, so we have a very, very powerful advisory for the proxy context called ISS. If you see ISS Wall Street Journal, they're everywhere, called Institutional Shareholder Service. They are the premier advisory for institutional investors on how to vote. They're not very, no, if you look at number, they're pretty neutral, okay? Because they support dissident 50% of the chance. Nicola, have a question?
Yes, we do. Connor
Yeah.
asks, what determines whether it will be a non-contested election versus a contested or proxy election? Can you go through that?
Yes,
Thank
very
you.
good question. In the absence of a dissident, then election will go on non-contested. Anyone can be a dissident. And once you're dissident, you file a form with the SEC, say, hey, I have a dissident slate. Anyone can do this. What is the threshold? I will say no threshold as long as you own at least $2,000 worth of stock, at least 100 shares. So, buy anything, you can become a dissident. That's what it is. Okay, a very good question. Thank you. So here we just say it's a very close context. Each side win about half the time, and the leading advisor advise supporting either side about half the time. Now, why this advisor is so powerful? Here's a number, okay? If you either side, management or the dissident, if you receive the ISS blessing, you win 70% of the time, okay? If you don't get blessing, 35% of the time. Now, I'm not saying the ISS caused the side to win because maybe you subscribe to ISS, you already agree with the general view, or the ISS is reflecting the general sentiment, okay? But this strong statistic correlation there. So once you see the ISS recommendation, usually in a few days before the vote is due, you kind of know who will win because it's 70% versus 35%. Another fun factor is the following. So I look at all the proxy contexts during the last 20 years. That's not a single time that a side can win if you lose the votes from all the big three. Okay, meaning if you don't get support from any of the three, Vanguard, BlackRock, and State Street, you know you're going to lose. So this is why some of the dissidents will talk to these three parties. They're allowed to make PowerPoint presentations in front of the big three. If they clearly see the writing on the wall, you're not going to get support, you should just withdraw. Okay. So for the typical public companies, these big three owns between 15 and 25% of votes. That's the typical range. Okay, so that's what I call the pivotal block. Now you immediately say this doesn't make sense. You're telling me three investors determine the fate of pretty much all the proxy context. This is why now we have a new reform starting from last year called a pass-through voting to the asset owners. So if I have time, I will talk about at the end of this talk. Okay, so this is the time series. Okay, so I updated data to 2023, but after my paper was published, we didn't update the data from the settled because like if you want to get the data from the settled cases, it's very, very difficult. You literally have to be like a forensic doctor to get all those evidence. So we didn't collect those, but we still have the data on actually voted proxy. Okay, so overall, you will see about 45% are voted. Okay, about 55% are settled and about 10% withdraw, meaning the dissidents saw no support. Okay, and they're not going to win, so they just halfway. I'm a dissident, and 10 days later, I say no, I withdraw. Okay, so that's the time series or how prevalent. You will see how prevalent it is. Okay, so if you look at the number, right? What strikes you is that in the big recession, 2008 and 2009, the numbers are very high. You'll say, wow, that was the stock market meltdown, right? Yeah, when the stock market meltdown, you have many unhappy or angry shareholders, and some of them turn into dissidents, and hence the proxy context. Okay, and if you look at 22 and 23, the number looks lower than usual, and people actually, the industry people indicated there's no decrease in the proxy contact attempt, and just more and more cases are settled through negotiation between the not so happy shareholders and the management to reach some middle of the ground solutions. Okay, so these two are my favorite cases. They're 80 years apart. with amazing symmetry or similarity, as you will see. Okay, so this I will go through briefly and see how the two cases 80 years apart could be so similar. Okay, so for example, let's look at the first column. Okay, so Benjamin Graham is the godfather of value investing. So if you ask a manager, if you're a fundamental investor, you probably have heard about the value investing, the famous book by Benjamin Graham, with many editions, but he's still the leading the thought leader in that space. Okay, so we are talking about in the 1920s. There is a public listed company called the Northern Pipeline. Okay, here's something interesting, because per share of that stock incorporates. So basically, if you look at the cash per share, when we see cash, no, we're not cash and cash equivalent and super liquid assets. Okay, but I'll just say cash. So cash per share is $95. Okay, but the stock price $65. What does it mean? If I liquidate a company today, the company has minimum liability. Okay, so that's not an issue. So if I liquidate a company today, I will get at least $95. Okay, I just throw away the machines and buildings and property, whatever, just get cash, 95. But if I hold the stock today, it's only worth $65. Okay. Wow, you see, this happens only because we didn't have efficient, effective capital market. The institutional investors not working. It will not happen today. No, it happened today. Okay, 80 years later. That company is called Yahoo. So Yahoo holds investment in Alibaba and Yahoo Japan, which is a fully owned subsidiary by the arm's length company. So Yahoo's holding of other companies was worth $45 billion. But Yahoo's total market value that incorporate those holdings are $39 billion. So what does it tell you? It tells you the market somehow is given a valuation of negative $6 billion for the Yahoo's core business. But the core business, if you throw it away, it's a zero. Okay, in fact, the core business managed to be sold to Verizon for $4.5 billion. Okay, so you will see those things happen. It's not about in the 1920s, before the SEC, before we have security law, before we have Vanguard and BlackRock, but it just happens. Okay, so there is a dissident. In the first case, Benjamin Graham held 5%. In the modern case, Starboard Value held 1.5%. Okay, so that amount allow you to become a dissident and say, I have a different view about where the company is going, and I want to send myself or my friends, quote friends, to the board. Okay, and what is their target? In the Northern Pipeline case, the dissidents say, let's distribute $90 per share of cash. Okay, the company is very liquid. Let's get our cash out and you run the company whatever you want. I already cashed in $90. And Starboard Value said the same thing. Let's sell Yahoo's main business. Okay, so we can lock in the $45 billion of assets that represent portfolio holdings in Alibaba and Yahoo Japan. Okay, now what do you think is the management response? No. Okay, and how to resolve it? Proxy context. Okay, now if you have 5% votes, 1.7% votes, you really are not confident that shareholders will all come your way. Not because shareholders don't like your proposal, it's what we call the shareholder apathy. So if I were a shareholder, say I own 1,000 shares in Yahoo, okay? I like the dissident idea, but I say, my 1,000 shares are not going to be pivotal in election. Okay, if some other people show up, the proposal went through, great, I benefit. But it's not worth my time to, take a day leave or spend some time to looking through the proxy votes, to submit my form. And in the end, my 1,000 shares will not matter. Okay, so this is what shareholder apathy is about. It's not they don't like you, they just don't mind to lift their fingers to do anything for you. So you need to lock in some block partners in front. Okay, so in the North Pipeline case, that big friend, his name is John D. Rockefeller, 23%. And in the modern case, they're called institutional investors, including Vanguard, Goldman, State Street, BlackRock, Bank of America. So these institutions collectively own 25%. Okay, so once you log in the pivotal block, then you can allow the retail investors show up, not show up. And Grant got elected to the board and distribute $70 of cash immediately. And Starboard gained 4 seats on Yahoo. And Yahoo sold its main business to Verizon for $4.5 billion. Okay, so let's look at Yahoo's case. Remember, before the proxy context, the company's total market value was 39. Now they gained the business of $4.5 billion, and they still have the $45 billion, which are portfolio holdings in the other companies. So that means they are improving their value from $39 billion to about $50 billion. So that is a win-win to everybody. Okay, so these are, I hope now you can see, I was just amazed when I found these 2 cases, okay, with such parallel, almost identical features, even though they're 80 years apart. It just showed the fundamental forces of shareholder democracy really has not changed much because we set up a very, very robust system. Okay, so the next one, I'll show you who are owning and who are voting. Okay, so the numbers look very, very simple, right? But in fact, it is 20 years of data work because it's aggregated over all the companies, all the contexts, all the investors. Then we can see this chart. Okay, so the incumbent block, the CEOs, C-suites, board directors, their family trust, etc., on average own 10.9. And they will 100% show up in the voting because they hold the biggest stake in this game. The dissident block, meaning the lead dissident and what they call their wolf pack. The wolf pack is a real name, their wolf pack. They collectively own close to 10%. So you can see that these 2 blocks are very head-to-head and neck-to-neck. Okay, so they really need the votes from the other side. That's why they run public campaigns as if their vote were primary candidates or presidential candidates. Okay, the institutional shareholders in a typical company own collectively close to 50%. And their voting participation is 90%, not 100%. I would think 90% is pretty good. Some small institutions say, I don't want to spend money to subscribe to ISS advisory service, and we have a 5 people shop. I'm not going to hire someone to do research, and if I cast the uninformed vote, I might as well just don't cast vote. Okay, so that's the argument. So I view 90% to be a pretty good show-up rate. Nicola, question?
Yeah, could you explain the wolf pack in a little more detail? Who are those people? Thanks.
Oh, very good. So the wolf pack are the like-minded investors, usually other activist hedge funds or other profit-driven hedge funds. So they do not formally collude or collaborate with the dissidents, but there is an understanding they will vote their bloc to support the dissident. So they work like a wolf pack, meaning we will work together to go against a common prey, what they view as common prey, which is the incumbent manager and board members in the target the company. Okay, so lastly, we come to this green pack. They are other. Who are the other? They are the retail shareholders, okay, like you and me, okay? So these retail shareholders collectively own about 30% of the stock, and they show up 40% of the time. Now, I don't believe they show up 40% of the time. I think they probably show up 10% of the time. So where does 40% come from? A lot of time, you have your shares with Charles Schwab, with Fidelity, and many times they voted for you. They ask, hey, do you want us to vote for you? You probably replied yes, or you defaulted in. You're not even aware that your shares are voting, okay? But just on the book, 40% of the retail shares are voted. Okay, so that is a real context. Okay, so I can tell 3 war stories. Nicola, yes.
Yeah, sorry, can you go back to that one? So just to make sure we understand the colors on the chart.
Yes.
So am I correct that the incumbent block of the total shares, the incumbent block is 10.9%,
Yeah,
and 100% of them are voting.
exactly.
That the retail investors, the other, is sort of 30.1% of my shares,
Yeah,
and 40% of that 30.1% are voting. Is that
exactly. Exactly.
okay?
So they
All
like
right.
contribute to 12% of the votes, not
Okay.
their share. Yeah,
Thank you.
yeah, very good. Yeah. So currently there is a big movement, a little bit surprisingly, driven by technology entrepreneurs. They are trying to set up systems to encourage retail shareholders to show up for voting. So if we have retail shareholders show up 90%, it will quite change the landscape of proxy voting. So that's something I also give it to people to think about. These are the three most dramatic stories in the history of the world. Okay, so in the Hewlett-Packard versus Hewlett-Packard, Hewlett versus Hewlett-Packard. Now, HP, for the young audience, no longer quite know what HP is about. Our generation know that HP, they start this firm in a garage at Stanford and go to the world leader in the printing business. So Hewlett is one of the two, the descendant, the son of the founder Hewlett and Packard. So they have a Hewlett-Packard. But the son of the founder Hewlett was very unhappy with how the company was run by the current managers, which is outside the office, outside of the family office, right? So it's a founder's son versus the current management proxy context. Of course, the founder's son owned a lot of shares. Okay, so that proxy context was in 2001, right before I graduated from my PhD program, University of Chicago. I was called by my broker, asked me which direction I want to vote. Okay, I probably own like 80 shares. Okay, the reason I got called is that context was so close that the winning margin is 0.8%. I want to explain a little bit about what a winning margin is. A winning margin is the minimum percentage of votes if they switch side that will change the voting outcome. Okay, that's what a winning margin is. So basically, in the Hewlett versus Hewlett-Packard case, there are 12 pivotal investors, meaning if one of these 12 investors switch from one side to the other side, the outcome will be switched. Okay, so in this case, Hewlett-Packard win, and later I will show you why they win. They didn't quite win in the most convincing way. Now we go to Triumph versus DuPont in 2015. That was a 2.5, and there are six pivotal investors. Now, if I go to here, if you look at the top 10 investors, basically any of this, Vanguard, State Street, BlackRock, Bank of America, like any of those six switch side, the result will be different. Now, the most deadly closest proxy concept was Triumph versus Procter & Gamble in 2017. And that winning margin was 16 basis points, okay? And only require, less than 500,000 shares, and there are about 100 pivotal shareholders. Now, Triumph won, the company must, just deeply regret, like if I had reached out to any of the 100, wine, dine, whatever, convince them to switch side, it would be different, but it's just that close, okay? So, this is actually closer. This is I think this is similar to the 2016 the Bush versus not it's 2000 which is 2000 something, the Al Gore versus Bush. Okay, that is similar. Just it was a couple of 6,000 votes in Florida determined the outcome. So the corporate equivalent of that presidential election will be Triumph versus P&G. Okay. Each of them have a story. So, I can spend 2 days talking about stories. I have breakfast with you in person and we can talk about those stories. But today, just let me go through very, very quickly. The Hewlett-Packard context was very, very controversial because one pivotal investor was called the Deutsche Bank. Okay. Now, Deutsche Bank holds 17 million shares, and you will see, the minimum pivotal share 11. So Deutsche Bank was a pivotal investor. Okay, now Deutsche Bank was also a financial advisor. He was a co-advisor together with Goldman Sachs to to advise the merge. Now, if you're advisor, okay, of course you want the merger to go through. You want the merger to go through because the merger goes through, you get the fees. So there is a lot of controversy surrounding the role of the voting of Deutsche Bank, okay? They voted for the merger to go through so they can earn the advisory fee, okay? But they also have shares in their portfolio manager. So they own shares on the buy side and sell side, that's the usual work, right? So they were criticized for not voting in the best interest of their clients in the asset management division, but voted in favor of a deal so that the investment banking division could earn the very lucrative fee. Okay, so how they exactly, what motive exactly vote, we don't know, but it didn't look good given the conflict role of Deutsche Bank in this case. Okay, now the DuPont context was famous for the mobilization of retail shareholders. Now, before I say shareholders didn't show up, in the DuPont context, the management won, and the management should thank the retail shareholders who showed up for them. Why did the retail shareholders show up for DuPont? Okay, because DuPont is an iconic American company, especially the shareholders, the old shareholders, right? They didn't like the fact that these iconic American companies are just disrupted by a handful of very loud voiced activists. That's their view. I don't necessarily agree with that view, but that is a large group of wealthy old shareholders living from the old era of the grand days of DuPont. They didn't like the company they know as an icon to be disrupted this way. Okay, now Twine spent $8 million and contacted 175 shareholders. DuPont spent $15 million and reached out to 200 shareholders, mostly, of course, institutional shareholders. There is an interesting story in this. The votes were conducted. You can conduct, just like presidential election, you can give the votes by mail, okay? And you can also show up and vote. So a lot of retail investors actually show up at the annual shareholder meeting and vote in person on the hard copies of the ballots. There was one retail shareholder was voted his about 5,000 shares, and he was going around and asked who has a staple, who has a staple. So people remember that staple asking guy has 5,000 shares. When DuPont collected the shares, they didn't see the stapled $5,000 share ballot. And they know they have to track down that share because retail shareholders in expectation will support the management. So the DuPont team went ahead and asked, did you see that staple guide? Did you see that staple guide? In the end, they located the 5,000 shares and happily claimed those votes to their side. So these just show how close votes could be and how important role even a not so large retail investors can play. Now the P&G, remember, it is a 16 basis point, difference. This is, I think that 16 basis point is not the truth. It's the conceded number. That's what you should remember. Okay. So remember in the Al Gore versus Bush presidential election, I still remember it was 2000. Now remember, I still remember that evening. Okay, before I went to the bed, we say, "Oh, George Bush will be the president." In the midnight when I went up, I was told, "Oh, Al Gore will be our president." And I woke up in the morning, I was told, we don't have a president, okay? So the same thing happened in this P&G context. Initial count indicated Twine narrowly lost. A recount showed Twine won by 43,000 votes, which is teeny for a gigantic company like P&G, okay? And some people say, should we recount? Should we do it again? The board had a meeting, decided to concede because the board say, whether it's 50.0001% or 49.999%, it is the shareholder voice that we heard, and we want to work with shareholders. So the board conceded and allow Twine's Nelson. So Nelson is the Twine's CEO and the founder. So they allow Nelson to join the board. So this is not the final count, but this is the conceded amount. Okay, so you see this, all these stories behind proxy context. Okay, now let me have, I think I have about, 5 minutes, let me just say what are the future, then I open up for questions. Okay, I will line up these few things. Is dual class here to stay? I think yes. Okay, it's very popular among innovative tech firms. The important things that we must have a sunsetting rule for the dual class share. So Meta, if Zuckerberg is managing the fine, but if his grandson is managing it, we don't think we should have a dual class structure. Okay, there is a lot of conflict between shareholders. Passive and active managers view different ways. Short-term versus long-term view different ways. Should we have a tenure-based voting? That's one proposal, and some exchanges already start to adopt it. Meaning, if I hold the share for 1 year, get 1 vote, 2 years, get 2 votes, 10 or more, get 10 votes. So it's a dual class by the length of your holding. And there's a lot of talk about using the new blockchain technology to establish DAOs for retail shareholders to record and register and participate in the voting. There's tons of conflict interest within the same shareholders. We already saw from the DuPont, the Hewlett-Packard case. Okay, what if I'm a shareholder? I own 1,000 shares and I short 1,000 shares, so my net share is 0, but shorting does not take away my voting. I can still vote. So in theory, I can be a big shareholder and short twice as much and vote in the direction that hurt the company and hurt shareholder value. How do we design? So this is called empty voting or encumbered voting. It's a controversial, still in discussion among the legal scholars. The proxy plumbing is a huge mess. Okay, so people thinking our proxy voting plumbing is literally like this. You cannot trace out who's voting what. It took us a lot of time to trace out who's voting what. But we do think it's hopeful that blockchain is the future. Now, the final is that do we want the big three to have such concentrated power? So now the new proposal is pass-through voting from asset managers to the asset owners. So basically, BlackRock had to seek my input about how I want to vote despite I hold a teeny amount of shares. Okay, so let me finish here and say the takeaway. Number 1, please exercise your rights as a shareholder in the era of pass-through voting. Next time, show up and vote on Elon Musk's pay. If your corporate manager take heat from shareholder voting, they could sell your shares, walk away, but they could air their voice and listen. If you as a manager understand your fiduciary duty towards shareholders, both in portfolio management, you also owe the duty in proxy voting. Now, if you're looking for a career, the proxy advisory intermediation is a growing arena. Okay, because there's so many fights, both sides need such talents. If you're a digital technologist, please help fixing the proxy plumbing. And if you're a curious learner, I'm one of those, and we'll keep tuned for new development. So I will stop here and let people ask questions.
Wow. We do have a number of questions. Thank you so much, Wei. This is a totally different area than I think about on most days. David asks or says, this is illuminating. Most of the time when I get these notices, I dismiss them. How does the SEC allow conflict of interest?
So conflict, I would think, there is no interest if there's no conflict. Conflict interest just a staple of business. I also see a question, did Deutsche Bank suffer from legal ramifications? The answer is yes, they got a warning, they had a settlement. Okay, so basically, if an investor, if I'm personally interested, I can vote whatever my way. But if you're as a manager, if you're clearly conflicted, okay, it is better to delegate your decision to a third-party institution. Like if you just say, I follow ISS, you'll be completely clear. But it is something one needs to manage.
Right. Okay. So you posed a series of questions, I think the second to last slide. Yeah. Who decides on those questions? What body decides whether or not empty voting or incumbent voting should be allowed or not allowed?
So currently, there is no codified law to prevent empty voting, because our system cannot catch anyone who own 1 million shares and short 2 million shares. There's not such, of course, I think with the technology, this is why I say the proxy plumbing is a mess. We need an aggregated system to have everybody's economic interests aligned. So right now, there is no such codified law, but if someone is caught doing it, there will be lawsuits based along the fraud line of the legality. So people can sue you, basically commit effectively a fraud, and the lawsuit will go that way. So there will be people who are damaged by your action, they can sue you. So I think the legal liability is real, but there's no codified law to prevent empty voting.
Okay.
Yeah.
Connor asks, did Deutsche Bank suffer legal ramifications for voting against their clientele and against their fiduciary responsibilities?
Yes, so there was legal ramifications. It was in the headline all the time. They were sued, by some unhappy asset owners. There was no suit going to the trial, meaning they settled in one way or another. So when they settle, they always have the confidentiality agreement. So everybody understood they settled in some way. They were punished in some way, but it was not a dramatic punishment.
Okay. So what kinds of firms, what kind of companies are likely to face dissident shareholders and proxy contests?
So no, in one word, unhappy shareholders. So no, when shareholders are unhappy, some of them turn into dissident. So the usual suspect, and you have low stock return, you have low return on assets. Those are the usual suspects. But turning away from the usual metrics, I find some metrics are interesting for something to become a target. One is that if the average basis of your shareholder is high, then you're vulnerable, even if you're doing fine. So for example, if the shareholders, most of your shareholders bought your shares in 2007, okay? Now, you're toasted because in 2008, 2009, they will be so angry because most of them bought in 2007. But if most of them bought in 2008, then you're safe in 2009 because everybody suffers. So the average basis of the shareholders would matter. And the other one is that these days people don't like the nepotistic look of the C-suites and board. Like if they think all your board members are your Harvard classmates, or the current CEO is the son of the previous CEO, those just invite extra scrutiny because they don't believe you were legitimately selected from very wide open pool. There might be something wrong, not always, but at least they will take an extra look at you, and if they find problems, a proxy context could arise.
Mm-hmm. Connor asks, for proxy contests that end up in settlement, do you have any sense of the outcomes of those settlements? Is there a give and take, total acquiescence to one side?
Yes.
How does that work?
Yes, so I have the only comprehensive empirical paper on this topic. We'll publish in Journal of Financial Economics. They're very, very detailed. It takes tons of effort to collect those data because they're not in the public space. So anyone who's interested, please email me. I will send you the link of that paper. It explains very, very much in detail everything you want to know, probably.
Okay, and more, no doubt. So the universal ballots were implemented in 2022. Does that help or hurt activist investors?
So let me first, explain what a universal ballot means. Okay, so before about 3 years ago, you must vote on one side of the ballot. Okay, so if the incumbent promoted 5 candidates and the dissident advocate 5 different candidates, you might like 3 people from here, but 2 people from here. I would like to do a mix and match. You cannot do that. You can only vote on one side. And if you like the 3, don't like the 2, what do? You vote for the 3 and withhold the 2, but you cannot submit the 2 you like from the dissident ballot. So the SEC changed this rule because many, especially investors, complain, say we want to mix and match. So that's called a universal ballot rule, because you can put the 2 ballots together and vote, say, the 5 of your favorite. Okay, so overall, it makes easier to the dissident to get one representative on the board, but it makes more difficult for the dissident to get all their slates to be on the board.
I see. Okay, thank you. So in recent years, or what have you seen in terms of the behavior of C-suite as this sort of activity, shareholder activity has developed and perhaps changed in terms of the causes of it, you know, what causes what, well, the interests of the dissidents. Have you also seen anecdotally or empirically whether or not management is changing their behaviors in any way?
Dramatically, because of this prevalence, like proxy context developed into very, very mature protocol, as well as we have a few celebrity dissidents, like the early associate, Starboard Value, Kai Icon, Triumph Partners, you know, all the shareholders, management, you know, are scared, not the right word, but they become very, very alert, because the one CEO said, one large company, S&P 500 company CEO said, the worst thing could happen to you is that you walk in the office on Monday morning and your assistant say, Kyle Icon is on the other side of the line. That's no, then you know you're in trouble. So in the past, I think CEO had the mentality say, if my shareholders don't like me, they would just dump my shares. Okay, my price drops, I get the message, but you know, if you don't like me, walk away. But that philosophy has completely changed. So these days, shareholders say, why should I walk away? I'm the owner. No, you work for me. You know, if I don't like the way you do, I want you to do my way. So that's a complete mentality change. And that have sipped into the CEO. The CEO no longer think, don't like me, sell my share. That's no longer the mainstream view. Now, the second one is that all the boards right now, they have exercise called self-activism. So meaning when the board have a meeting, we'll say, suppose we are activists against our own company. What are the weaknesses or vulnerabilities we would pick up? Because they have all the information. They have all the information. So they will say, okay, we identify 5 vulnerabilities, and how do we fix them or mitigate ourselves so that we don't become the targets of the outside shareholders. Now, the last thing, I think the main change that is I mentioned in the last of the slide, like if you look for a finance career that is not super quant, but require a lot of institutional knowledge, interpersonal skill, I think this activism defense is a growing stage. It's a growing stage. So every major investment bank, you know, Goldman, Morgan, JP Morgan, they all developing their activist advisory business. So the activist advisory business on a normal good weather day, they're doing some activist audits on a company, say, hey, if you are targeted by the activists, what kind of activists could be, what an issue they're going to raise, and you get prepared. And they could also be the advisory after the shotgun marriage. Say the activists already show up, what I'm supposed to do, what kind of speech should I make, how do I communicate with the shareholders? So that business is getting stronger and stronger, and for that reason, we are seeing fewer proxy contexts actually going into the vote because there's so many intermediaries will make sure the case gets settled.
That's fascinating. So on one hand, we've got our crisis leadership type, crisis management type practices that have come up, and then on the other hand, we've got this activism preparation come up. Thank you so much,
Yes.
Wei. This has been a fascinating look into activism and shareholders, and I'm no longer going to just throw that
away your ballot. Exactly.
my ballot. Thank you so much.
Thank you so much, everybody. Hope we can have real breakfast together. But thanks for being here with me. Thank you. Bye-bye.
Thank you.
Thank
I'm
you.
going to hand over to Tammy.
Thank you so much, Wei. Thank you, everybody, for joining us this morning. We really appreciate it. We want to make you aware of future Business Over Breakfast coming up. So on February the 6th, which is the first Thursday of February, The Keys to Persuasive Storytelling for Business with Professor Steve Savage. So we hope that you're able to join us for that conversation. We want to also make you aware of some short courses. Nicola mentioned a lot of those at the beginning. So we do have some asynchronous digital courses that are available for you. Digital Disruption and Transformation, AI for Business Success, and Leveraging Analytics for Growth. We also have our in-person managerial leadership program, which is taking place on March the 25th, in April the 14th to the 16th, and it ends May 19th and 20th. This is an in-person leadership program that you can attend. We also have our Executive Communication and Leadership Presence course, which is also in person on March the 26th and 27th. And finally, if you're definitely interested in learning the fundamentals of AI and understanding how it works and how you can use it within your own business at work, please join us for Leveraging AI for Business on April the 30th through May the 1st. All of these courses can be found on our website, or you can email us at executiveeducation@emory.edu. Again, thank you all for joining us. We appreciate you taking this time out of your busy mornings to hear from us during business over breakfast. Take care and have a wonderful rest of your day.